Good. During the break, I've told you that you should do some revision on PPE before we're going to continue in the second semester. So what do you have to know about PPE before we're going to commence with the study unit? The first thing is you love accounting and you love fixed assets. Second thing is you should know what costs form part of the cost price of a non-current asset. Now here the rules are exactly the same as with inventory. All the costs that you incurred in order to get that asset into your possession, which will enable you to use the asset for the purpose that you have acquired it, all those costs needs to be capitalized as part of the cost price of an asset. So no longer it is only the invoice price of the asset. If I, for example, purchased a machine, yes, the purchase price of the machine, the invoice price of the machine, obviously that will be the main component of the cost price of that machine. But if I had that machine delivered at my premises, then that delivery cost will form part of the cost price of the asset. If I had to install the machine before I can start using the machine, that installation cost will form part of the cost price of the asset. So all the costs that you've incurred in order to enable you to use the asset for the purpose it was acquired for, all those costs form part of the cost price of an asset. Now what about VAT? Now again, if I am a VAT vendor and I have purchased from another VAT vendor, then I can claim the VAT and the VAT won't form part of the cost price of an asset. But if I am a non-VAT vendor and I purchase from a VAT vendor, that vendor is going to issue a VAT invoice to me. But because I am not registered for VAT, I will not be able to claim the VAT. So in circumstances like that, the VAT will be capitalized as part of the cost price of the asset. Only if I am a non-VAT vendor and I purchase from a VAT vendor. Now, what is the difference between the cost price of a non-current asset and the depreciable value of a non-current asset? Now, we've already defined the cost price of the asset. Now, what is the depreciable value of the asset? Guys, that is the total depreciation that we're going to write off on that asset over the lifetime of the asset. So depreciable value is not necessarily equal to the cost price of the asset. If I expect that I will receive something for that asset I'm going to use at the end of the estimated lifetime of that asset, i.e. the estimated residual value of the asset, then I'm not going to depreciate that. It's not going to be a cost factor in my books because I'm going to recover that amount of money at the end of the lifetime of the asset. So the depreciable value of the asset is going to be the cost price of the asset less the estimated residual value of the non-current asset. Now here you must be careful because you have to distinguish between the different depreciation methods that you can apply. When I'm using the straight line method, I'm working on the depreciable value of the asset, i.e. the cost price less the estimated residual value. And remember, this estimated residual value is always a VAT exclusive amount if I am a VAT vendor. If I'm not a VAT vendor, it will be the VAT inclusive amount because there won't be any VAT applicable because I cannot issue a VAT invoice. Right. So, in the straight line method, the depreciable amount will be the cost price of the asset less the estimated residual value of the asset divided by the estimated lifetime of the asset, and that will be my depreciation charge on an annual basis. Straight line means every year I'm going to write off the same depreciation expense. If I'm using the production unit method, again I'm going to work on the depreciable value of the asset. The cost price of the asset less the estimated residual value of the asset divided now by the total capacity of the asset. If it was a machine I had acquired and the capacity of that machine is, let's assume, 10,000 units, the total capacity of that asset, so the number of units that it can produce over its estimated lifetime is 10,000 units. So I'm going to take the depreciable value divided by the capacity of 10,000, and that will give me a price per unit that I'm going to produce. Then my depreciation charge will be that price per unit multiplied by the number of units which was actually manufactured in the current financial period. Good. If I'm working on the diminishing balance method, then I do not work on the so-called depreciable value of the asset. On the diminishing balance method, I have to work on the carrying value of the asset as at the beginning of the current financial year, multiplied by the percentage that I'm going to write off as a depreciation charge on an annual basis. Now that percentage that I'm going to write off, that will already include the estimated residual value at the end of the lifetime of the asset. So if I'm going to apply that percentage on an annual basis, I will only, by the end of the estimated lifetime of the asset, have depreciated the asset up to its residual value automatically. Now this year I will not require from you to do those calculations to work out the percentage on the diminishing balance method. I will give you the percentage. But next year you will have to calculate that diminishing balance percentage in order to derive at the estimated residual value of the asset as at the end of its lifetime. Good. So make sure that you know how to calculate depreciation by applying each of those three methods independently. Now, what do I do, or let's say, when we start providing for depreciation? Now, on the diminishing balance method and the straight line method, we will only start providing for depreciation after we've acquired an asset at the date that the asset was ready to be used. Not the actual date that I started to use the asset, not the date that I've acquired the asset, the date that I was able to start using the asset for the purpose that I've acquired that asset for. So watch out for this one, because I'm going to catch you out if you're only going to take the acquisition date or the date that we actually started using the asset when there was a different date where we would be able to start using the asset if we wanted to. What about idle time? Let's assume that we have a factory with a lot of machinery, and let's assume that every year we close the factory in the month of December. Half of December we do maintenance work in the factory, and we service our machines, upgrade our machines, things like that. And then the second part of December we close the factory because it's Christmas holidays. What do we do out of a depreciation point of view? Now, if we use the production unit method, it doesn't matter. Why? Because we base the depreciation charge on the actual number of units produced during the period. However, if we use the straight line method or the diminishing balance method, this is my dog that's doing the heavy breathing here, if you can hear that. So if we use the straight line method or the diminishing balance method, then we are going to ignore the fact that there was idle time during the year. So we will still make provision for depreciation for the full 12 months of the year. If we did use that asset 12 months for the year, let's assume we've acquired the asset on the 1st of January, and then for the month of December we close down the factory. We will still have depreciation based on the straight line method and the diminishing balance method for the full 12 months of the year. Now, this guy is a bit confused. He says, I'm an asset to my company, an investment to my wife, a liability to the environment, and a write-off to my children. I can't tell anymore where my balance sheet ends and the business metaphors begins. Now, this poor bloke, he doesn't know whether he's coming or going. Please, don't be like him. Right, what do we have to do further? You further have to do the accounting entries for the acquisition of a new asset. the disposal of an asset, the trade-in of a non-current asset. Now, when we dispose or trade in an asset, we are making use of an asset disposal account. So you should know what is the purpose of an asset disposal account and how the accounting entries work. Now again, VAT. Where does VAT come into play? VAT now only come into play when I sell an asset or trade in an asset and I receive money for the old asset. Now the receiver of revenue says if you are a VAT vendor, when you purchase that asset that you disposed of or traded in now, you have claimed the VAT. So therefore now when you're selling the asset, you have to pay me over the VAT which is included in the proceeds on the sale or the trade-in of the asset. So the amount that will go to my asset disposal account will only be the amount that I'm entitled on, so the VAT exclusive amount of the proceeds. The VAT portion will go to the VAT output account where I have to pay it over to the receiver of revenue. The last thing is the IAS 16 note, which is all about the disclosure. So in this semester, we're going to ask you that note. Now, in the Level C exam, the first question, upload question, was all about the carrying value of the assets as at the end of the year. And a lot of you did the note in order to derive at the carrying value at the end of the year, which is 100% fine, no problem with that. The only problem is that about 80% of you got it wrong. Because you didn't realize, number one, what should be shown where in that note. Number two, you did not realize that that note should balance. Guys, it should cross balance and it should down balance. So if it doesn't balance, then it means that the note is wrong and you've made a mistake somewhere. So please go back to the IAS 16 note. Please make sure that you understand what should be disclosed on a line-by-line basis and 100% make sure that you know how to balance and see whether your note reconciles. Good, so if you have all this knowledge now, then you are ready to take it one step further and we're going to do a little bit more about PPE.